that one timer there. Thank you. Well, good morning, everyone. It's my pleasure to welcome you all here to our mini budget breakfast this morning, on behalf of Clarke Willmott and AC Mole. And I'm pleased, as usual, to welcome many of you who I know are joining us online as well this morning. For those of you I've not met before, my name is Lexi Shaw. I'm Managing Partner at AC Mole, and I'm joined again this morning by Amanda Gunter, Tax Partner at AC Mole, and Tom Chiffers from the Private Client Team at Clarke Willmott. And it'd be fair to say, when I was thinking I would introduce things this morning, I was like, well, there's probably quite a lot to talk about, to be fair, for a mini budget, and obviously quite controversial, I think it would be fair to say. But I'm an accountant, as you may know, and as an accountant, I quite like a set of accounts. I think there's some value to be had from a set of accounts. And obviously, with this being not a formal budget, with it being a fiscal event, there's been a lot less modelling around the impact of some of the announcements that have been made. So I kind of went back and thought of it from a broader perspective, from a country perspective, and I'm not sure how many of you will be aware. But in the past, what we've done is use something called a set of national accounts, which is what's informed some of the decision-making process in the budget. Now, I'm sure many of you, I can't imagine any of you, will have seen a set of national accounts, but they don't look like a set of accounts that you would recognise either. So this is the accounts that are kind of put together at a government level. To start with, they're done on what we call like an income and expenditure basis. So it's just the money you've received and the money going out. And there's this concept of accruals accounting, which us accountants like, which is where if you're committed to spend something, you kind of recognise that as a liability in your accounts. So we didn't do that, we don't do that in our national accounts. Nor do we do them on the basis of any accounting framework that would be recognised, and they're not audited either. So, interestingly enough, there was some commentary on these and the adequacy of these accounts for decision-making processes at government level. And certainly as an accountant, I'm sure anyone in this room, if you had clients or businesses that you're working with, you'd probably advise them that it's good to have a set of accounts to base some of your financial decisions on. So there was this concept introduced of what's called whole government accounts, which was a set of what we perhaps call more normal accounts. So they were based around a recognised accounting framework, international financial reporting standards. So that's great. You've got some rules that you're going to prepare these accounts around. They were also done on an accruals basis, and they included all of your assets and all of your liabilities, and they were audited. So that would give you some confidence over the numbers in them. Anyone like to guess when the last set of accounts we've got available as a country were made up to? What financial reporting have you got, Amanda?
Only because you told me.
Yes, 31st of March 2020. And they were released in June of this year. So 26 months after the end of the financial period. Now, those accounts as at March 2020 at a country level showed that we had net liabilities just short of £5 trillion. So that's in excess of our liabilities over our assets. Now, just to show the importance of preparing accounts on a more meaningful basis, the national accounts, which is what we've been using previously, for that, at that same date had the same figure as being 1.8 trillion. So it gives you the kind of importance of having a complete set of accounts. But obviously, March 2020 was pre-COVID, pre-furlough, pre-bounce-back loans. And so as a country, we don't actually have a set of accounts available for any date after March 2020 on a kind of recognised accounting basis. The March 2021 accounts are due to be released in March 2023, so a full 2 years later. Now, and I just really struggle with that conceptually. I mean, call me an accountant, I know, and I do like my accounts, and I like a set of accounts that's been audited, I like them to have a recognised accounting framework, but I just can't imagine any business making decisions that are being informed by a set of accounts that were based at March 2020. I do really struggle with that as a concept. So, and there were lots of things and I could talk about this morning, but I thought it would be interesting just to kind of give that background as to how we prepare accounts and what information we have available at a kind of government level to underpin some of these decisions that we're making at the moment. But anyway, having depressed the room, I'll pass you over to our first speaker this morning, which is Amanda. What I would say, we will do the usual Q&A session at the end, and obviously if you're joining online, there is the ability to ask questions if you're logged on using your Google account, so we will take questions at the end. Over to Amanda.
Thank you, Lexi. Hey, good morning, everyone. As Lexi mentioned, I'm Amanda Gunter, and I am one of the partners at AC Mole. Now, unfortunately, I'm not sure I'm going to actually help with the level of depression that's going to happen here. The downside is I don't actually have the clicky thing to change my slides. Thank you. Thank you. So, as we all saw from the first slide, this was classed as a mini budget. So why a mini budget, considering everything that was actually announced last Friday? There was certainly nothing mini about it. Now, the official title was the Growth Plan 2022. So the fiscal event that happened on Friday was not headed up as a budget by the government, it was a growth plan. And I will say, we will see in a minute, that growth is what they are really backing the horse for. So, are we going to see another budget? Yes, we will. Now, in any normal budget, you often see the Chancellor will present the state of the economy in the first part of his speech. And he runs through what's happened historically in our income and expenditure, and then he reports on the forecasts which are produced by the Office for Budget Responsibility. Now, the government has to give the OBR 10 weeks' notice to prepare this report. Now, the fact that they had about 5 days meant that we weren't going to get that OBR report. Now, I noticed this morning that they have actually given us a date for the Chancellor to stand up again and give us this report, being the 23rd of November. So I would anticipate that we are going to see a budget on the 23rd of November, and that's a traditional budget. Now, as of Friday, I was sat in the conference room with Rebecca, and we were listening to this mini budget. And at the end of it, I did think, well, we won't hear any other tax policies or tax cutting ideas in the actual budget, because we have seen so much in that one time. However, listening to the commentary over the weekend, they are saying that they could look at further tax cuts. So I think I might be wrong. I think that when we get to the end of November and they do present the OBR's report, that we could see more tax changes, which, considering everything that happened last Friday, is actually quite scary. So, more tax cuts, potentially. So I mentioned it's the growth plan, and that does seem to be what the government is focusing on. So throughout the PORA report, when you actually read it, this is what they are targeting. They want to target medium-term stable growth of 2.5%. Now that doesn't sound too bad, 2.5%, when you sort of think, okay, growth of 2.5%, surely we can achieve that. But let's just put that into context. So as of last year, the OBR were predicting growth this year to be over 3%. That's been dropped now, and I was on a Bank of England presentation a few weeks ago, and they were looking at potential growth for this year of about 2.1%, so which will be below the 2.5%. I had a quick Google and had a look on the Office for National Statistics, and our growth up to June 2022 stood at 1.9%. So the Bank of England putting it at 2.1 could be around about right. But looking forwards, we aren't going to be achieving 2.5% for quite some time. As of last year, the OBR was saying that for 2023, we would achieve growth of 1.8%. However, the Bank of England, when they were giving their presentation, they were looking at us going into a recession by the end of the year. That recession was going to last for 5 quarters, is what they were originally predicting. That's just over a year. Now, as we can see from that, we're not achieving our 2.5% growth that we need in order for the measures that the government have put in place to work to actually pan out. So when they are saying medium-term stable growth of 2.5%, they have got to be looking at a term plan of 3+ years in order for it to work. Don't look so horrified. So the Bank of England presentation that I went to actually happened the day after the government announced their energy bill. And the energy crisis has been top of everyone's talking points for quite some time. Now, Kwasi Kwarteng, during his speech, the first thing he started to talk about was what they've done in relation to this energy crisis. So we now have an energy price guarantee. Every household is going to receive £400 towards their bills over the winter, which we were told about some time ago, so that wasn't new. But the other new one is the Energy Bill Relief Scheme. Now, the difference between the two, the Energy Price Guarantee and the Energy Bill Relief Scheme, is that one's for individuals, and that's the price guarantee, and the other one is for businesses. Now, both of them work in a similar fashion in the fact that the government is going to cap our unit price for energy. Now, that doesn't mean that our suppliers aren't going to charge as much, it just means that the government is going to pay the excess on it. Now, for individuals, the energy price guarantee is supposed to be running for 2 years, and for businesses, the Energy Bill Relief Scheme at the moment is said to run for 6 months. Now, this is quite a costly thing for the government. You can see there that it says cost 60 billion. You can also see that there's quite a lot of question marks around it. The government don't know how much it's going to cost them. And there's a couple of reasons they don't know how much it's going to cost them. Firstly, they haven't yet agreed the pricing with the suppliers. Now, they were hopeful that they were going to be able to agree supply pricing at lower rates, because energy pricing is fluctuating daily. So they were hoping that that 60 billion was going to be a little bit less, thanks to negotiations with suppliers. However, what's happened over the weekend since everything that happened on Friday? Sterling has crashed. What do we buy our energy in? Dollars. Now, when we were getting an exchange rate of 1.2, 1.3, that wasn't particularly great. I think it stabilised overnight at 1.07. That's put up our energy pricing. That 60 billion will not have taken account of the crash in sterling. So it could go up rather than down. Again, this does get better at some point. So energy prices are going to continue to fuel our inflation rate. So the other thing on everyone's minds at the moment is inflation. Now, we've been talking about this for the last 12 months, and unfortunately, inflation has got worse. My little graph. So in 2020, we were seeing inflation at roughly 3%. 2021, it was really starting to pick up. About a year ago, the Office for Budget Responsibilities were saying that inflation this year was going to hit an average of 7.4%. Inflation last month hit 9.9%. The forecasts that the Bank of England were presenting a couple of weeks ago were looking at 13.1% by the time we get to the end of the year. The crash in sterling will not have a positive impact on inflation rates. Now, does anyone know what the government's target for inflation is? If you've listened to me before, you might. It's 2%. 2. This line down here. 2%. We are a long way off. Now, the measures that the government takes to try and get inflation under control is through the help of the Bank of England. And that's in interest rates. Now, if anyone's seen the news this morning, we all know what's happening with interest rates. Now, we have seen, and my colleague Rebecca told me the other day, we've seen 6 increases this year in the interest rates for the bank from the Bank of England. There is talk that they may do something more quickly than the 3rd of November when they next meet. So we could be seeing interest rates going up again. I read a couple of bits on the BBC website this morning where they were saying potentially we could be seeing interest rates on mortgages next year of about 5.8%. Now, when people have been used to borrowing at much lower rates, this is going to be a real high cost for people over the coming 12 months. There we go. Normally, one of the things we find in the Chancellor's presentation that he does give us a summary of our borrowing and debt position. Because we didn't have the ABR's report, we didn't have that. But we will be presented with it when he stands up on the 23rd of November. So we will have more information on the current state of our borrowing and our future requirements for borrowing. But just through a quick search, we could find some information. So our debt at 31st of March stood at 2.365 trillion. Quite a big number. Now I can remember I did a slide on this last October and I put in an estimate for the March figure of 2.4, so it was roughly right. Now we are going to need to continue to borrow. We needed to borrow even before they had the energy bills in. So the fact that we are now getting that benefit of the energy bill of roughly 60 billion, that's an increased borrowing on what they were previously expecting to borrow. Now, normally from a Conservative government, we would expect them to be thinking about how to actually reduce our borrowing instead of increasing them. So it's quite a change in policy. We are going to need to borrow for the foreseeable future. Now, it doesn't say what the foreseeable future is, but I think we can all tell by everything I've said so far, it's not a short period of time. Now, I've given you enough negatives, so I thought I would give you a positive here. In the Chancellor's speech, he did mention that the UK has got the 2nd lowest debt to GDP in the G7. Now, his speech was quite fast, but I did pick up on that one point, and I thought, I'm just going to double check that and see what it is. So our debt to GDP stands at 99%. Quite high gearing. But I'll have a look at the others, just to see if they were right. France, 114%. US, 124%. So I threw that one in because I just thought you might need cheering up at this point in time. So what did he do? So some of the specifics. A year ago, I stood up and I was talking about the increase in national insurance of 1.25%. It's all been scrapped. So everything that I said historically, just ignore it. The 1.25% was an increase this year in our national insurance, and next year was going to be reclassified as a social care levy. Okay, that has just literally been scrapped from the 6th of November, and it applies to employees, employers, and the self-employed. Now, for employees and employers, it will be scrapped through the pay roll. For the self-employed, I started thinking about this, that how can you scrap something part of the way through when you pay Class 4 national insurance? It's going to be a combined rate. So we are going to have a very strange rate of national insurance for Class 4 and anyone who's self-employed. I did a quick calculation, and it's an adjustment of something like 0.79% for the year. Now, I feel quite sorry for software providers, because it's our software providers that are going to have to get this dealt with fairly quickly in order for payrolls to be run after the 6th of November to take account of this 1.25% change. And then our software providers are going to have to sort their software out for Class 4 national insurance by changing the rates ready for next year. So I think they've got quite a big task. Now, if you read through some of the notes, it does mention in there that actually employees and employers may find that they have to play catch up in January and December and January if their software isn't ready. So I think the revenue are expecting that some software providers won't be ready for this. Now, I mentioned a quick note at the bottom. What happens to the NHS? The reason we had the 1.25% rate in the first place is because it was going to be ring-fenced for the NHS to help improve our NHS system. So when they said about scrapping this straight away, I thought, well, how's that going to work if you were going to give it to the NHS? Reading through the notes, they are still going to allocate an equivalent amount as they would have raised through this additional 1.25% to the NHS. They're just going to ring fence it from our normal income tax and national insurance contributions rather than using this additional. Postal tax. Well, this was the shocker, I've got to admit, because I didn't predict half of this actually before it happened to the budget. Additional rate has been scrapped. So at the moment we've got a 45% tax rate. That applies for anyone who's got income over 150,000. That additional rate will be scrapped from next year. Now, my apologies, I do just see that says from 5th of April, it should say 6th of April for next year. When he announced this, I was quite surprised, I think along with the rest of the country, but the next one I wasn't so surprised at because it had already been muted. So our basic rate of tax is dropping from 20% to 19%. Now this had already been on the cards because we heard last year that this was an intention that they were going to drop the basic rate to 19%, but originally it was going to be dropped from 2024. They've brought that forward, so we are now seeing it from next year, 2023. So that one wasn't such a surprise. Now our higher rate of tax does remain at 40%. But you'll also note on there the tax rate on dividends. So last year, when we were seeing the 1.25% national insurance rate, they also said they were going to increase the dividend tax rate by that 1.25. So our rates this year on dividends, we have 8.75%, 33.75%, but we've also got an additional rate on dividends of 39.35%. That's what we've got this year. Next year, for dividends, we'll have 7.5 and 32.5, and we won't have that top rate on dividends. So Rebecca and I were talking straight after the budget, and your brain starts going of, oh, what can we do? Tax planning. So a little tip. If you've got, say, if you were thinking of declaring a dividend in March, don't. Declare it the year after. So declare it on the 6th of April. Now, if you're an additional rate taxpayer, you can be saving 6.25% on if you're doing things like that. So there is some tax planning to be done. Now, I'm self-employed as one of the partners, so I obviously then thought, is there anything we can do? Now, my only thought at that point was, can I go on sabbatical for the next 3 months and then work twice as hard next year? No, I can't, which is very unfortunate. But if anyone has got the opportunity of maybe thinking, okay, I won't work so much this year and I'll work a bit more next year, there is some tax savings to be done there. So, company taxation. Again, this wasn't a surprise. We knew this was coming because it's been talked about quite a lot over the last couple of months. The corporation tax rate was due to go up to 25% next year. That's been scrapped. So our corporation tax rate will continue at 19%. Now, there's probably quite a lot of businesses out there, particularly the larger ones, that have done a reasonable amount of planning in relation to try and get profits taxed at 19% in comparison to 25%. So everything they paid for all of that planning was a waste of time. The next one again, possibly not a surprise. So this time last year, I was saying that the annual investment allowance was going to drop to 200,000 next year, and we were thinking about planning on when you'd actually incur capital expenditure. Now, even last year, the government was saying that they were going to be looking at the corporate tax regime and in particular things like annual investment allowance. And I did predict that the annual investment allowance wouldn't drop to 200,000. The thing I didn't predict was that they would have a permanent 1 million annual investment allowance. So that was the one thing that he did add into his budget, that is a permanent change. Now, the other thing they mentioned on the company tax front is IR35. Now, for anyone who recognises IR35, then it's a very specific piece of legislation in relation to personal services companies. The rules changed in 2017 and 2021, so that an engager had to consider someone's status. They've all been scrapped, and we are back to what we had beforehand for IR35, where the individual running a personal service company now will have to consider their status rather than the engager. So it's sorting it out. There was a lot of work done by organisations in relation to IR35, and for it to be scrapped in one foul swoop, it's probably quite upsetting for a lot of people who were involved with it. Now, what didn't change? Now, I did sit there afterwards thinking, I mean, what hasn't actually changed, because so much has? Well, one thing that didn't, and this was the one I thought might have, personal allowance, didn't change. So you may remember that our personal allowances were being frozen for a 5-year period. So we've still got our personal allowance at £12,570. That's due to remain the same until 2025-26. Now, when we were originally looking at how the UK was going to pay for COVID and actually get itself back on its feet, this was one of the things that did it. By freezing allowances and the higher rate thresholds, it did bring back in a reasonable amount of money. Now, he didn't mention anything about personal allowances in there, but when they've said that they may be looking at further tax cuts, we may see changes on this front by the end of November. The higher rate threshold didn't change. That is still at £50,270, and again, it's frozen for the same period of time. And the higher rate for non-dividend income is remaining at 40%, and for dividend incomes remaining at 32.5%. After having listened to the budget, it was quite nice to think of something that hadn't changed. Now, we did a quick Google, and the Institute for Fiscal Studies said that this had been the biggest tax-cutting event since 1972. Now, for a mini budget, that's quite a big statement. Now, on that note, I am going to pass you over to Tom, who I think he's going to actually cheer you up a little bit more than I have.
Thank you, Amanda. Morning, everyone. Great to be back in front of you all and all the people at home. For those who don't know me, my name's Tom Chiffers. I work for Clarke Willmott in the private capital team here in Taunton. And yes, a mini budget, nothing really mini about it, or a fiscal event, I think we're supposed to call it. I'll be talking a bit about stamp duty and then a little bit about the now defunct Office of Tax Simplification. So starting with stamp duty land tax, for those who don't know, for the unlearned amongst you, it's paid during a property transaction, calculated against the consideration and paid by the buyer. As with the rest of the theme, as Amanda was talking about, we've had some cuts, or rather we've had some adjustments to the zero band. So like income tax, stamp duty land tax is paid on threshold, so you have a threshold of a certain rate and then it's all calculated like that. The zero rate band has doubled, so from the date of the budget it doubled from £125,000 to £250,000. But then for first time buyers also had an increase of £125,000, went up from £300,000 to £425,000. So we didn't have time to do any planning, it was just announced on the date, so we didn't have a big run up. He announced it and it came in straight away. So what does that mean for everyone? Well, the reason he did it was supposedly to support growth, increase confidence and help families aspiring to own their own homes. Well, that doesn't really mean anything to anyone, but there we go, that's what he says. But as anyone who listened to the news or watched the news this morning, you'll know that this is all done in the context of mortgage rates going up, the pound dropping, and there was lots of banks last night and this morning all pulling mortgage products because they don't want to fix them. They're not going to be affordable because everyone is expecting, as Amanda said, we've already had big interest rate rises. I think 6, Amanda said already this year, and we're probably going to have another one quite soon. So is this actually going to make any difference? You know, is this going to generate increased revenue? Is it going to create more impetus into the housing market? So what did SCLT bring in? So for the year, the 12 months to August 2022, it brought in 17.5 billion, which was a record for SDLT. But in the context of the wider tax revenue, that's only about sort of 2 or 3% of the total tax revenue. So it's not one of the big ones, but it is fairly significant. So what does that mean for the taxpayer? Where are we going to see that now? So this is what the rates are. So forgive me if you can't see the slides, but we've got the first 250,000 at 0. The next amount between 250 and 925,000 is at 5%, and then 10% between 925,000 and 1.5 million, and then anything above 1.5 million is at 12%. So those rates haven't changed, it's the bands that have changed. And then for first-time buyers, as I said, that has increased to 425,000, so that's at 0%, and then between 425,000 and 625,000, that's at 5%. If you're a first-time buyer and you're lucky or unlucky enough to be buying above 625,000, you don't benefit from these rates. You go back to the regular rates, as I just showed you. If you're buying an additional property, if you are not essentially selling your home and buying a new one, or you're buying a first-time property, so if you're buying a second or a third home, or you're buying as a trustee, then you have the additional 3% rate on top of those rates that I just quoted. So the first 0 to 250,000 is 3, and then we have 8 rather than 5, and 13 rather than 10, and 15 rather than 12. So those rates haven't changed, nothing's changed there. They still remain the same. So if you're buying a second or a third home, you still pay that extra 3% rate. So what does it mean? The average house price currently, according to Savills, is £344,179, very specific amount. So that means with the new rate you'll pay stamp duty and tax of £4,708. That's calculated as I put up there. So the first 250 is at 0, and the next 94,000 is at 5%. So that means we get 4,709. So that is a saving of £2,500. So you save £2,500, the average house price we save £2,500 every time you purchase, or in sort of percentage terms, that's about a third. That's 35%. So the average house price will save about a third of stamp duty after the 23rd of September. So how does that look in the regions? You won't be able to see this, so it's probably too small. Again, this is from Savills' website. So England, the average house price for England, as I've said, is 344,000. Compared to the regions, London, average house price, £608,000. And then in the north east, the average house price is 177,000. So when you compare that saving, London right at the top is still going to save 2,500, as is the southwest of England is going to save 2,500, which is just above the average rate. But as a percentage term, that means us in the southwest are going to save about 30%. But in London, compared to the whole stamp duty and land tax calculation, they're only going to save 12%. But if you're in the regions who their house prices are lower than the national average, if you're down in the northeast, you're not going to pay any stamp duty and land tax at all. You're going to be now out of the stamp duty and land tax regime because the average house price is 177,000. The old threshold was 125,000, so you are now, on the average house price there, a non-stamp duty and land tax payer. And then the other regions, so West Midlands, East Midlands, you're now saving about 2/3. And then the rest of the regions you are, again, not paying any stamp duty and land tax. So those people in the northwest, Yorkshire and Humber northeast, the average house price is now under the threshold. So there'll be lots of people in those regions who are no longer troubled by stamp duty. Everywhere else who's above, like the southwest, will all save 2,500. London only going to save 12% of stamp duty land tax. How does that affect first-time buyers? Well, the analysis there is reversed. All the regions, except for the southeast and London, won't notice any difference at all, based on average house price, I should say. So the average first-time buyer house price for England was 243,000. So very comfortably under the 300,000 threshold we had before. In fact, all of the regions are under that threshold except for the southeast and London. It's only really London which was well above, which was 436. So that means that the only savings we have in London, which saves about 80% of the stamp duty, and then for the southeast, now the average house price for a first-time buyer is now under that threshold. Everyone else doesn't make any difference at all. So, for those of you with not even long memories, short-term memories, 2 years ago, we had the stamp duty land tax holiday introduced as part of the regime trying to boost the economy as a result of the COVID lockdown. It was called a stamp duty land tax holiday, and I don't think many of my colleagues, Mark's sitting in the front, so I look at him, in the conveyancing world, had much of a holiday, in fact had any holiday. I remember we had a bonus, an extra day's holiday. The whole firm closed. There was a little note at the bottom to say, if you're in the conveyancing team and you don't want to take this holiday, then you don't have to. Because I think it was in one of these spikes that I mentioned here. So it really distorted the market. Now the market was already heating up because people wanted to get out of the city. They wanted to come down here. They wanted to come into the countryside. But the stamp duty land tax holiday really gave a shot in the arm. It was a real rocket, and it distorted the market. And there was 3 spikes. First spike was the expected end in March 2021. Then when it was reduced, that was extended, the can was kicked down the road to June 2021, and then when it finally ended in September. There were 3 big spikes in the market. And it wasn't just that it created a boom, it really locked the whole system up. So again, if you're having anything to do with the land registry, you'll notice that they're, a year, 18 months, slow in terms of actually processing anything, returning anything. So it really created a lot of problems. But what it did do was meant that 500,000 people who would have otherwise paid stamp duty and land tax didn't. So 500,000 people didn't pay any when they would have done it. But what it did was increase transactions over £500,000 by 70%. Is what the government described as a surge. It was a surge in these transactions over that amount. So what did it do actually to the government's revenue? You've just seen in my first slide, it's over 17 billion is the receipt for the year to August. The period whilst the holiday was going on, that went down to 9.62 billion. So a reduction, but actually, compared to 2018-2019, that was only a reduction in 1 billion. So then if you see what it was last year, compared to what it was in 2021, suddenly we've got an extra 8 billion of stamp duty and land tax receipts this last year compared to 2021. So the real impact was, yes, they did lose a little bit of money and they did increase and send the whole market crazy. But what they did was really created a rapid growth in the last 2 years in house prices. Because the old adage is, if you reduce the rates, then the buyers pay because the sellers put the prices up, and if you increase the rates, the sellers pay. And that's what happened here. We really had a boost in the house price rise. That rise has continued to grow. And so what we're seeing now is that stamp duty and land tax receipts have gone up, nearly doubled. And so perhaps you could interpret what's happening now as more of a correction than a reduction. It's predicted that the receipts will be about back to the levels they were in 18-19. So what they found when they had the holiday was that the receipts on homes over £1 million increased by nearly a half. So that went up to 1.62 million, or 2.7 of transactions, and that created 50% of the receipts. So you ended up, by pushing house prices up, you ended up meaning that more receipts came from the higher value. According to Labour, that meant that a third of the people who benefited from that holiday were buying a second home or a third home or buy-to-let property. Again, we don't know whether that's the case or not. I can't verify that, but certainly what it did do is it really increased the market, really pushed it on, and this, I would interpret it as being more of a correction rather than a reduction, putting us back to where we were in 1819. So a quick word before I hand over for questions on the Office of Tax Simplification. Now, most of you won't have heard of the Office of Tax Simplification. It's something that Amanda and the rest of the people from AC Vault, and certainly me, as a tax lawyer, do know about, because you fervently read their reports thinking, all of these changes are going to come in, we better start planning and worrying about it. Actually, in the end, nothing happened. So you'd ignore it, and then you'd certainly then think next time, and then you'd still worry about it. I remember rushing up and down the motorway trying to get some documents signed on the 1st of March 2021, because everyone was worried that capital gains tax rates were going to go up. It didn't happen, but I still had a fun day rushing around getting things signed. So Office of Tax Simplification was shut down to boost economic growth and, ironically, simplify the tax system. So ironic to get rid of the Office of Tax Simplification because you're trying to simplify the tax system, but there we go. The irony is obviously lost on the Chancellor. It's been around since 2010. The aim was to try and simplify, streamline the tax system and remove those complexities, which anyone who advises on tax knows that the system is complex, and therefore any changes are complex because it gets itself tied into knots as more and more people change it, and it doesn't get easier. So it was an independent office. It's now essentially going to be integrated within all of the Office of HM Revenue and Customs. What that means in real terms is it's being built, and forgetting about it existed. Now, what did it actually do? Did it actually do anything? Did it change anything? As I've said, I'm conscious of it because you read lots of these fantastic reports, they're very detailed, come up with lots of things that could happen or should happen, and none of those do happen. So these are some of the headline ones that certainly that I remember. July 2019 proposed lots of changes to inheritance tax. So those are changes of changing business property relief, agricultural property relief, even changing the fundamental way in which inheritance tax is paid during people's lifetime. So you might have had to pay, one of the proposals was you would pay inheritance tax when you make gifts during your lifetime, which is one of the sort of fundamental principles that doesn't apply, which tries to encourage people to give things away during their lifetime. Also the changes to capital gains tax, as I was talking about, running around thinking they might implement those changes the following March, which they didn't do. And then last year they proposed changing our tax year to make it more in line with the rest of the world, specifically with the continent. None of those things happened. Those were the big things. Those were the headline things that didn't go anywhere. What were their successes? Well, they did have some success on the sort of smaller scale. The smaller things that actually did get implemented. So they proposed changing the way that inheritance tax returns were submitted, so less people needed to do a complicated return. They proposed extending the capital gains tax limit for submitting residential property returns from 30 to 60 days. And they also changed the way that self-assessment returns are done and simplifying employee benefits. So those are all things that were done, but probably no one really noticed because those are simple things, they're relatively superficial. So what does this tell us? What does this mean, the fact the Office of Tax Simplification has been consigned to the bin? Well, I think what it says is it really highlights the fact that there are two systems at work. You've got the bureaucratic system of the Treasury and HM Revenue and Customs trying to make the tax system actually work, trying to make it pay its own way and generate revenue for the government. And then you've got the politicians on the other end who are trying to make a statement, they're trying to win votes, and they're trying to implement a tax system that is going to seem attractive to people. And you see here, unfortunately, the Office of Tax Simplification, they were the victim of this. They were the victim of trying to make too many changes, trying to propose changes that were too significant and perhaps not politically enticing enough for the government. So they're gone. They're no longer here. That's it. That's the end for me. So I'll hand over to Lexi, who can field any questions in the room or on the computers.
Thank you very much, Tom, and thanks, Amanda. It's always really great to hear your insight on some of the changes in perspective. May I ask you to join me, simply then you can field the questions. Let me just take this one as well. So actually, we do have some questions online, so I'll start with these, if that's okay. So that should put it up on the screen with any luck. Is that on? Yes, there we go. So this question is, when the government talk about growth of 2.5%, does this take account of the effect of inflation, in real terms?
In very simple terms, yes, it's supposed to. That's the one thing that when I was at the Bank of England presentation they did say, is that it should take into account inflation when they are looking at that growth. So yeah, a very short answer, but yes, it should.
Thanks, Amanda. Do we have any questions in the room as well? Would anyone like to pick Amanda or Tom's brain? All stunned silence. Everyone's very depressed, aren't they? By the news this morning. It's very flat in the room. That's actually the extent of all I've had on. Do we have any? I see a hand at the back. Stuart, of course we can rely on you.
Is there a sign in any of this of altering the rules about registration of trusts? And when they might come in and might not come in, because that could be a real pain for a lot of professionals.
That's a good question. Tom?
Morning, Stuart. I haven't seen anything at all. I was like you, expecting that they might do what they've done many, many times before and relax the rules, but it doesn't seem like it. I certainly haven't seen anything. Amanda, have you seen anything?
I haven't either.
No.
I think on that point, Stuart, the registration of trust is more an anti-money laundering thing, because the government think that the trust is designed to hide money from them rather than a tax strategy.
Yeah.
Never really up for grabs.
No. Okay. Thank you.
No, it's also actually, America has also dictated a lot of our reporting requirements, which has included the trust registration. There's been that underlying it as well. So yeah, it's not something that I would expect to see in relation to them relaxing that trust registration issue.
Oh no, that's it. They have relaxed the penalties, I think, haven't they, which might be worth mentioning.
Yeah, so for anyone who doesn't know, all trusts had to be registered as of the end of September. The one thing they did announce as we got very close to the September deadline and I was panicking about going on holiday, was the fact that if they weren't registered, they're going to take a light touch. Now, I think that was probably to be expected. You know, there's a lot of people who don't know that trusts need to be registered, and therefore, how can you penalise them for it? They did say they will take a light touch on that. I think to the degree that they said that HMRC would write to someone first to say you need to get your trust registered. As long as someone acts on that, then they wouldn't look at penalising anyone. So there has been a very light touch that they're going to take in relation to any form of penalties for late registration of trusts.
Thank you. Any further questions? Yes.
You mentioned obviously energy prices continue to fuel inflation. We see obviously in terms of interest rates going up, energy prices keep going up. Do you just see that as just continuing to rise? Where do you see an end to that? Because Ukraine and Russia is probably going to go on for many years to come. Where do you see this ending? Because you keep putting the rate, they put the rates up at Bank of England, inflation keeps rising.
Completely right. It's a vicious circle. And that's the way we see it at the moment, is we are seeing this happening. How does it stop? We don't know, and I don't think anyone knows. The only thing that we can see from it is we are seeing a lot of pressure in relation to the big suppliers of energy. So if you have a look at the US news in relation to ExxonMobil, and they're basically saying over there, we're going to tell the whole world how much profits you are going to make. Now, to me, that's not enough. I can see how much profits they're making. That's not a problem. They need to have a little bit more of an impact to try and do something about it. At the moment, I don't think anyone knows the answer. And you're completely right. It does feel like it's just a vicious circle of going up and up and up. And how do you break that? I don't think the announcements that happened on Friday helped us understand how it's going to be dealt with. I'd like to think we will hear more. So when we do hear the next statement, sort of 23rd of November at the moment when it's forecasted, that we might see exactly what their plan is. They did say they were going to actually speak about this medium-term growth plan and put some meat on the bones. So maybe we will see where it is going. But I think it is, I've heard the word geopolitical used quite a lot over the last few weeks. It is. It's not just a UK issue. Now, we are seeing it quite hard at the moment, but it is a worldwide issue. And this crisis in relation to energy, there's got to be a stop at some point. But I don't think anyone knows how or when that's going to happen.
Do you want to add anything to that? Emily? Oh, there's one at the back.
In your opinion, how low is the pound going to have to go against the dollar before it triggers an emergency interest rate rise?
Any takers on that? But just for anyone who's online and didn't hear it, so the question was, how low do you think the pound will have to go against the dollar before there's an emergency interest rate rise?
Not much further. I think the Bank of England were basically saying that they weren't looking to put up interest rates until their next meeting on the 3rd of November. I'm not sure that will happen. I think that they're starting to feel a bit more of a panic. Things did stabilise a little bit last night on that. If we were to see them drop again, I don't think it would take very much for them to actually have an emergency increase in the rates that they're charging. So we could be seeing 0.25% in a shorter period of time than the 3rd of November. I'd like to think, and this is my optimistic note, I'd really like to think that things will stabilise. We had the shock on Friday of everything. The markets reacted in a shocked fashion. I'm really hopeful that that will stabilise, because as the news goes down and it becomes old news, it would be really nice if that does stabilise, but I don't think it would take very much. Everyone's going to go back really quite down, aren't they?
Still, don't shoot the messenger. Unless there's any further questions, we will then draw it to a close. Obviously, I'd like to thank Amanda and Tom for their really insightful presentations. Obviously, we will be hanging around as well, so do feel free to nub us afterwards if there's anything else you'd like to ask. And thank you all very much for joining us this morning. Thanks.